Ladies and gentlemen, good day and welcome to the Prestige Estates Q1 FY2024 Investors Conference Call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Samar Sarda from Axis Capital Limited. Thank you and over to you, sir.
Thanks, Yusuf. Good evening, everybody. As always, we have the senior management of Prestige Estates for the post-results conference call. Mr. Irfan Rathal, the Chairman and Managing Director, Mr. Venkat Narayan, the CEO, and Amit Mor, the CFO. We'll now hand over the call to the management for the initial comments.
Hi everybody, this is Irfan here. Hello Samar. I think I'll hand it over to Venkat to just summarize what has happened during the quarter and then I'm available for any questions.
Thank you, sir. Thanks, Samar, and good afternoon to all of you. We have had exceptional quarter. We had a great beginning for the fiscal FY24. The total sales for the quarter stood at 3,915 crores, up by 30% year-on-year. Collections are at 2,741 crores, up 28%. There's significant growth in average realization per square foot, up by 20%. They're at 10,244 when it comes to apartments and 5,000 when it comes to plots. We have sold 2,276 units this quarter at around run rate of 760 homes per month being sold, aggregating to 3.83 million square foot of area. Q1 this fiscal we had one launch, though our launch plan for the fiscal is huge. We had one launch in the form of Prestige Lavender Fields, which was instant sellout. There was a great response and significant amount of contributions for this quarter sales have come from that project. Mumbai continues to contribute at a good run rate. We had 600 crores of sales from Mumbai coming in. 450 crores of sales have come from Prestige City at Mulund and balance have come from between Prestige Resident Classic and at Mahalakshmi and Prestige Pali Hills at Prestige Daffodils at Pali Hills. In terms of completion and launches, we had overall 3.11 million square foot of launch. That's one launch, Prestige Lavender Fields. And we have completions of 5.9 million square foot spread across 4 projects. Prestige Great Acres at the Prestige City, Prestige Marigold, Product Development Project, Prestige Elysian, Bangalore at Banagata Road, and Prestige Mulberry Shade, Hospitality projects. And the launch pipeline for the rest of the year is very robust. We have large project coming up for launch in the form of Prestige Park Grove in Bangalore, the Prestige City at Hyderabad, Prestige Parava Gardens at Chennai, Prestige Bogan Hill Garden at Noida, which is going to be our maiden launch, first project launch at the NCR region. We're looking forward, we're excited, we're looking forward for the rest of the year and these launches. And with this, I think we'll continue with the same momentum, maybe do better than what we've done in this quarter. Moving on to financial highlights, this quarter had a little dip in overall revenue recognition. We had total top line. This is linked, as all you know, to the completion of the project. We don't have much of a completed inventory. So the instant recognition of revenue by way of selling of completed inventory is not there any longer. So whenever we sell the inventory, this is just launched or ongoing. So they come for recognition only when the project gets completed. So therefore, we had only 1,966 crores of revenue coming from as a financial turnover. Total EBITDA stood at 812, PAT at 317, the percentages that you see are driven by exceptional item, which is, with respect to REIT units that we hold on a retail portfolio. When we sold our malls to Blackstone, we continued to hold 15% of those malls, and we converted that into units, and we also invested a little extra money and hold around 4.5% of the overall REIT, because we did mark to market of those units from original cost to where they're currently getting traded. There's an exceptional item that got recognized, which contributed to the extent of 240 crores to EBITDA and 210 crores to PAT. So therefore, you see EBITDA number at 41% and PAT at 16%. Leaving this aside, in general, because the fixed expenditure is almost same quarter on quarter, irrespective of whether we're booking 3,000 crores or 4,000 crores for top line, or 1,966 crores the way we have done this quarter. That continues to be same. Therefore, you will see a slight change in dip in the profit margin, even after removing exceptional item. Because there's some queries that had come in this regard. Therefore, I'm making use of this opportunity, the opening remarks itself, to clarify to all of you. Now, moving on to the construction spend and cash flows. The overall construction spend for this quarter has been at 1,774 crores, split between various segments of our business. Residential and commercial, which are developmental business, residential primarily, we have spent around 1,200 crores. Commercial office space projects, we spent 350 crores. Retail, we have spent 75 crores. And hospitality, around 165 crores. This has been overall spend. And there's a lot of money that we have invested towards the new land acquisitions and stake buys. That's almost around 1,300 crores in the quarter. But if you look at operationally, we had 2,716 crores of collection from the development business, and we spent 1,182 crores on construction of developmental business. And after subtracting the landowner payment, sales and sales and marketing expenses, employee admin expenses and everything, we had operationally very positive net cash flows at 1,000 crores, and the remaining money what we invested is towards acquisitions. The point that we would like to highlight is we've been seeing a significant amount of growth in our pre-sale numbers. Most of you have tracked year after year. From pre-COVID year of 3,800 to we moved to 5,000 plus crores of sales, and then to 10,000 plus crores of sales, and last year close to 13,000 crores of sales. And this year we get it for more. There's a substantial amount of money that we have invested in development, the acquisitions for the new launches. Between 5-6 projects at Bangalore, which is getting launched, as you mentioned, this is Bagro, this is City Hyderabad, Ocean Towers Marine Line, this is Nautilus at Worli, and there's one more project that we took over from the fund belonging to other developer, the 400. Between these 5-6 projects, we have invested around 3,000 crores towards business development, and all of these projects will be launched from now to maximum period of 15 months or so. So a lot of unlocking will happen from these investments as and when these projects get launched. The reason for a slight increase in the debt also is driven by this kind of acquisition that we have done, which according to us will set up a good base for us to clock good numbers in terms of pre-sales, and also help us grow if the demand and the momentum continues in the same fashion and the macroeconomic support, grow on that number next year. Because as you know, in the real estate, we can't buy land today and launch tomorrow. There is always a lead time. So these investments will result in great pre-sales numbers this year and as well as next year. With this brief, I would like to open the forum for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for taking my question. First question is on 1,300 crore land investment this quarter. If you can provide some breakup of on which all lands was this spent for, because in the pipeline, obviously I don't see any new projects getting added, but definitely it would be for some older projects. So if you can just help me with the breakup or some key investments that includes that 1,300 crore.
So sure, definitely. Yes, you are right. This is towards the balance payment that we have to make for the projects which are already in pipeline. Those include Prestige Nautilus at Worli, Prestige Ocean Tower at Marine Line, Prestige Park Grove that we're going to launch, and 2 projects at Electronic City as well as Banegada Road, and 175 crores of additional investment that we have made into REIT to consolidate our holding with the retail REIT. So this has been the broad breakup of where investments happened during this quarter.
Sure. And what was the idea behind investing some more in the REIT? I mean, was it part of the agreement that we have already signed up?
No, we had some convertible instruments. So option is either to get them redeemed or get them converted into the units of the REIT, and those were part paid. So we made the balance payment and took those units. That's a small amount compared to the percentage that we own.
Got it. And in terms of our cumulative capex outlay, there has been some increase this quarter. So obviously, since we added Mumbai commercial projects, hiked up our stake there, some bit of that increase would have come from there. So all of the additional spending required for Mumbai commercial projects is now part of that, 16,000 crore of total outlay?
It is right. If you are specifically asking after we bought out the partners last quarter, whether increase to the capex, that means we'll have to incur the construction cost on that portion also, whether it's been captured in, answer is yes. It's in the number that we are referring to.
Sure. And, is the estimates now pretty much, there in terms of the total spending, or there might be some revisions based on eventual, designing that we achieve for total portfolio? Yeah.
Trends are frozen unless there is a significant cost increase with respect to raw materials like steel, cement during the construction. These numbers hold good. And some contingencies also have been provided.
Sure. Got it. And one last on launches. So, Ocean Towers and Nautilus, both should be launched this year. Are we on track for that?
That's the plan.
And that would be, full launch at one go rather than at phases, right? Or how are you planning to do it?
We will be full launch at one go.
Sure, got it. And any idea on, total GDV that we are trying to launch this year with the projects that you highlighted earlier in the call?
Specifically to Mumbai, there in the last 2 slides. Other projects, if you see the
I'm in total, not specific to Mumbai, but in total.
Okay, so the 2 big projects, that is Prestige Park Grove. The overall top line is around 7,000 crores. Prestige City at Hyderabad will be again equivalent to 7,000 crores. Prestige Pallava Gardens at Chennai and Prestige Bougainville Gardens in Noida, both would be equivalent to around 4,500 crores. And these 2 major projects let me open the sheet for you. Ocean Towers and North-East put together would be around 9,000 crores.
Got it. And we have now a good clarity on Bougainvillea Garden launch in Noida, right? This is
last 3 weeks, there are significant developments with the authorities at Noida, and they have formed a committee, and the committee has found some solutions to address whatever the issues that have been pointed out with respect to sports cities. And they're putting up a resolution plan in the next meeting. With that, we're hoping that sanctions will come through.
Great. Okay. That answers my question. Thank you for answering, and all the best.
Thank you. Thanks.
Thank you. Next question is from the line of Adhidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, good evening, everyone. Thanks for the opportunity. So my first question is on the Delhi Aerocity Hotel. Could you just tell us what is the status of this project, and by when do we see the hotel becoming operational?
Maybe 2025 in December.
Hello? Oh, sorry, your voice is...
2025 is the scheduled date.
Okay, so this is like FY25 or FY26?
December 2025 and the hotel, and December 2024 is the office component.
FY25 will be office, FY26 will be hotel.
Okay. And sir, just to follow, since you have done some stake buyouts now for partner in the Mumbai projects, we also have a 50% stake in this project as well. So in this project and other projects where we still have the partner's share, can we expect some more stake buyouts in the next 12 to 18 months over here in that portfolio?
It with a case-to-case basis on a need base. In case the partner can't fund, obviously he'll start diluting his share. As of now, there's no such discussion. But obviously when we are funding more and the partner is unable to fund, then obviously we'll have to dilute him. But as of today, the partner has committed that he will bring his contribution wherever required. And when it doesn't come, obviously needs to be done.
Okay. Sir, and this final question is on our debt levels. In our analyst meet, we had given a roadmap on how the debt would pan out over the next 4 to 5 years. Now that we have done the stake acquisition, so considering all of this, would you like to revise, like in terms of where our debt numbers would be, possibly in the next 12 to 18 months, in terms of in absolute terms? Yeah.
Speaking as of now, we have robust cash flows coming in from the residential business, and also the debt on our hotel portfolio is compared to the investment that has been made and the value of the hotels is very minimal. So in all of this, we will definitely have some positive cash flows, and this will help us to go through this. And if at all any debt is required to complete the CapEx project we are on, yes, the debt will come in, but the balance sheet is strong enough to take that debt. And as and when the projects get completed, it will start fructifying. So I don't see any stress in that mode.
Just to add to someone is mentioning is this quarter we've guided in terms of debt equity ratio. So what happened this quarter, as I mentioned, is our turnover number is low. But as you know, what we have sold during the earlier years will start coming.
We have some 40,000-50,000 crores worth of unrecognized revenue.
Revenue recognition will start coming in. Once the top line increases, automatically net worth will go up and debt equity will be back. So this is only transition. But by the time we reach FY24, we'll be where that level will be where we have guided.
Okay, so just to end, so any stake acquisitions, our debt should be around 7 to 7,500 crores in absolute net debt towards the end of March 24. Is that a reasonable assumption to work with?
Yes. But having said that, that may still continue to be at whatever we have guided at around 0.5.
0.5. Okay, sir. Yeah, that's it from my side. Thank you and all the best.
Thank you. Next question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yes, sir. Hi. Congratulations on a decent quarter. Just wanted to update on the Mumbai BKC project. So, has the project achieved the financial closure of the after the partner stake buyout?
Yes, both the projects, BKC as well as Liberty Towers, we have done the financial closure. We are in the process of documentation now. We have not yet drawn the money. I think we'll complete the documentation and start drawing the money by end of this month.
And has the work started, because the BKC projects are still showing in the upcoming, so have not moved to the ongoing project? I think last time you said that you are already appointed a contractor. I think L&T has been awarded this contract. So if you can update us on the status of the project.
Well, the work has started. We are already doing piling. The excavation is going on. L&T is the contractor. So whatever work is happening is money from our contribution as equity. And moment the financial closure gets done, that much more gunpowder will be available for use.
Liberty Towers is already in the ongoing project. BKC is moved, but within in this quarter. So you'll see that from upcoming to ongoing by end of this quarter. This is as of 30th June what you see.
Second question is on this Ocean Tower. So we have bought out the partner stake, but the area share has gone down quarter on quarter. I think the last presentation we had about 1 million square feet of area. Now it is 0.81. So why is that?
There was never a partner in Ocean Tower. This is a bought-out land. We took it over from Edelweiss.
That land is 100% bought in Ocean Tower.
Yeah, so why the quarter on quarter, why the area share has gone down? I mean, 60% is our economic interest.
Economic interest also has been the same. It's been, from the beginning, it's been the same. It's just that in the final, whatever the sanction drawing that we have submitted for the approval, there could be a small difference. So about 1.35 total developable area and 0.81 is our share of the area. It's been the same. There is little change in the final drawings that would have taken place.
So our economic interest is 60%, so who has the balance 40% in this?
So this is done in entity called Prestige Projects Private Limited, where earlier HDFC was holding the stake, and that was bought out by the family office. So this project is happening in that SPV.
So 60% will be the main entity, and I think 40% is the family office.
Yeah.
Family office, whose family office? I mean, is there some other investor, third-party investor?
No, what is family office? No, just to tell you, Prestige Projects Private Limited (PPL) had is a SPV that had 60% from the listed company. 40% was held by HK.
Okay.
So HK's stake, when they were exiting at that point in time, was bought by from HK directly by the family office.
Okay.
This was 3 years ago.
Okay.
This project is executed in that SPV because we had cash flows in that SPV.
Okay, sure. And sir, our debt is now already gone up. Resi debt is at 4,400 crores. Our debt is now, I think, 6,400 crores. And we have about 17,000 crores of capex to be incurred, including all hospitality, retail, and office. If I assume that, even if you assume that 30-70 mix, or even if I take 50-50 mix, so the capex debt will go up to almost 8,000-9,000 crores. So we may end up somewhere with the debt number of 15,000-16,000 crores by the time all these assets get completed. So is it the right assumption that we may touch close to about 15,000-16,000 crores of debt?
Three things that we need to look at because of the growth that is happening in development business, especially residential, which is unprecedented. If you have to have growth from 5,000 to 10,000, 10,000 to 13,000, and this year we're looking at 16,000 to 18,000 crores. And we need to have that much of inventory to sell, and also the projects under planning for the next year, because there is always a lead time. So our investment into business development have significantly gone up. That's why across 5 projects that I mentioned, our outflow has been at 3,000 crores. All of these 5 projects will get launched from quarter on quarter in next 12 to 15 months, that money will get unlocked. I want you to see our slide 15, where the free cash flow that we can generate from residential business. As I mentioned, residential developmental business, even this quarter we had 1,000 plus crores of operating positive cash flows. The ongoing projects have got a surplus of 8,500 crores. Upcoming projects have got a surplus of around 21,000 crores. Both put together close to 29,000 crores, 29,930,000 crores of free cash flow that we can generate from residential. So this is the potential. So even if we are to fund 1/3 from residential to capex projects and borrow the remaining from the bank, by the time the commercial projects get completed, we'll have enough cash flows to pay back those money and retire the debt or do lease rental discounting. So you should look at why is the debt number high and what is that we are doing with that money and how are we meeting the growth.
Okay. But your resi debt at 4,000, I mean, will it be the peak? Because I understand you will have LRDs on commercial and you are going almost to 4,000 crores of rentals, so which itself is huge and can support the debt number on the capex. Especially on the LRD side, it can support it. But primarily on the residential debt, which is at 4,400, so how do you see that behaving over the next few quarters?
So what you said is correct. Overall, whatever we have to spend, we have to spend. But what you need to look at also is, if you have to spend that much of money on a capex portfolio, we will have an overall rental income of 3,500 crores. If you apply 8% cap on that, roughly the value of that will be around 45,000 crores by itself.
Right.
42,000 crores. That is the rental portfolio that we may have. And the debt, whatever you are mentioning, we may have to incur to build those assets. Absolutely, yes. But with that debt outflow or construction cost spend, look at the value that we are creating.
But the only question is whether you will monetize a part of that rental portfolio of 45,000 crores. Even a 10% can give you a large 5,000, 6,000 crores worth of roll down in terms of capital and reduce your debt significantly.
The thing is, these options of monetizing always exist, which we did 1.5 years ago with Blackstone, yielding portfolio, some of them under construction. We can do one more. They express their keenness to strengthen the relationship further and invest in some more of our assets. There are other PE investors who want to evaluate our ongoing office and retail portfolio. But then that is a difficult choice to make as to when is the ideal time. Is it now when the assets are under construction, or is it when the assets are ready, or should we at all do these kind of divestments, or should we go and list in a public platform? So these options exist. One thing I want to reiterate and assure all the analysts and investor community is that the quality of the assets that we are building are world class. They're second to none, and they will be the sought after assets with the value creation that is happening. How to unlock? There's always an option that is available. We can do it now if we choose to. We may get lesser value, or do it once they are ready. We may get better value. Go to public markets once and for all. We may get even better value.
So total maybe $5 billion of value you're open of the asset value of 40,000 crores, which you said. So potentially you're open up to like $1 billion kind of unlocking, maybe 7,000-8,000 crores if there is an option. And the only timing has to be decided based on how you feel would be the right time, right? So is it the right assessment?
Absolutely, yes.
Okay. Thank you, Venkat, and thank you, Irfanji, for my question.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all the participants in the conference, please limit your questions to 2 per participant. Next question is from the line of Runit Kapoor from Systematics Group. Please go ahead.
Hello. Hi, thanks for the opportunity. So this is regarding your Mumbai projects in Worli. So the Worli micro market has a lot of supply coming up. There's almost 10 to 12 million square feet coming up, like specifically the BDD Chawl redevelopment project. So a lot of mid-income housing is coming. So you have 2 projects in Worli. One is Nautilus and the Jijamata Nagar. So what configuration are you looking at in these projects? And Like, do you feel the velocity of sales will be affected given the large amount of supply coming up?
The Nautilus will be purely residential, but Jijamata, yes, there will be a mix of residential, a large retail bit as well as a hospitality asset in that, because it's all of 17 acres. Of course, there's a lot more time and a lot more work need to be done on Jijamata, and it's not going to see the light of day in the next 1 or 2 quarters. There's at least a good 6 quarters away. In the meanwhile, Nautilus is almost ready, and the type of location we have, I think, is second to none, with great spectacular views. And the design itself, we've done it in such a way that it's neither too large or too luxurious and not too small. So I believe that there will be a good appetite for it, and it is going to find a good response from the market.
So in Jijamata Nagar, I would say, like, you're looking at a mix of commercial as well as residential, but I'm saying, like, are you looking at mid-income housing, given that
it's a complete mix. That Jijamata Nagar, there will be a mix. It's a different type of product that will be done. We still honestly haven't put pen to pencil. Of course, there will be a large component of redevelopment also there, because we have to rehabilitate the slums also. So, yes, it's a very different type of project. It will be mixed use, completely mixed use. Depending on how, even by that time when we reach at that time, maybe even a small component of some serviced offices or something may also come. But it's to be...
It won't be pure luxury housing only. Like...
Right now, we are concentrating on seeing how we can get the land cleaned up. But Nautilus is ready. Nautilus can in the next couple of quarters. And Ocean Towers, of course, will get done this quarter.
And in terms of, like, the stake, do you plan to ramp up the stake? Like, it's 26% in Jijamata, and I think in Nautilus also you're holding around 40%, right?
No, Nautilus is it's there. The listed company is entirely with the group. It's not with any outsider. And
okay. So HBS has exited completely from this?
Yeah, HBS is exited, yes. Yeah.
Okay. And one more question on the Mumbai front. Are you planning any retail projects, like, because any retail malls in pipeline?
No, that's the one. That is, when Jijamata happens, that there is a good sort of potential for that. But then it's all remains to be seen how finally the planning happens.
Okay. And the last question on the hospitality front. Like, your occupancy rates, especially for the JW Marriott Golfshire, were dragging down the occupancy for your entire segment. So have they improved this quarter? Like, any update on that?
I didn't get the question.
So JW Marriott Golfshire Hotel was dragging down your occupancy for the entire hotel segment. So are the occupancies improved for the hotel segment this quarter? Hospitality segment?
Drag down the occupancy in the sense?
Hotel occupancy is like...
We don't all of them. No. JW is not low at all. It's a different product altogether, and the pricing itself is resort pricing. So it's a different positioning.
Okay. Fine, thank you. That's it from my side.
Thanks.
Thank you. Next question is from the line of Puneet Gulati from HSBC. Please go ahead.
Thank you so much, and congratulations on good performance. My first question is, why enter into an agreement where there is family ownership in one project and company ownership at the other, given that you have the entire business will be done within the listed entity.
When we were doing the Prestige City, which was in the SPV called Prestige Projects Private Limited, Lisco had 60% stake, and HCare had 40% stake. So overall holding cost of 60% for the Lisco was around little under 100 crores. 60% stake costed 100 crores. When HCare wanted to exit, their ask was around 440 crores for 40%. And at that point in time, when you had 60% holding coming to you at less than 100 crores, to buy 40% at 440 crores did not make meaningful sense. And at the same time, we did not want them to go on and sell it after an outsider and bring one outside equity partner. No, we had those cash flows. We said, okay, at that number, instead of that going for an outsider, why can't we look at it? We took clearances, what are the compliance, and then that money got invested. Rightly so, because instead of Lisco investing 440 crores to just get extra stake, that money got invested in various other projects and the business development happened. Once the project got launched, there was a surplus cash flows in that SPV itself. So that SPV invested in a couple of projects. That is how some projects have come into the SPV. When we did a financial transaction in that SPV, there was a constraint on upstreaming of cash flows till the project gets completed. So therefore, that SPV with the additional cash flow that was there after the project got launched, invested those monies and acquired two other projects.
So which are those? One is Ocean Tower. Is Nautilus also part of similar structure?
Nautilus is also been part of a similar structure, yes.
And who owns 60% of Nautilus?
Lisco owns 60% of it. It's one SPV that is doing all this.
Sorry, no, Lisco owns 40%, right, of Nautilus? Sorry, I couldn't hear you.
Lisco owns 60% when it comes to Ocean Tower, 51% in Nautilus.
Okay, presentation reads 40%. Okay, secondly, what are your thoughts on, future business development? What kind of capital are you likely to allocate over next 2 years for business development? And what is the balance to spend for any business development activities that you have already done?
We have enough in pipeline for the fiscal FY24 and FY25 to launch. Now, if any business development activity to do this year, that is going to be for FY26. Okay. And we have to clock numbers of 18,000 to 20,000 crores of sales. On an average, I think investment in the business development should be in the range of 4,000 to 5,000 crores a year.
4,000 to 5,000 crores a year. Okay.
A year. This considering the mix of JDs and outright buys and all of that.
Right. Understood. And in terms of cash flow for Jijamata Nagar, are these already a part of your upcoming cash flow projections?
It is.
So this amount of roughly 5,000 crore, is that all, or there could be more potential in terms of the area to be sold?
No. As of now, see, we get there when we are actually planning. Right now, we are looking at a master planning and also cleaning up and acquiring the entire land. We've not gone to the details of exactly what should be the composition, what should be the mix and all of that. Now, if we choose to exploit more and do only for sale, these numbers can go up.
Okay, so 5,000 crore is your share of cash flow from sales, and what will be the construction cost that you will have to spend on the 3 million square feet?
3 million square foot?
Yeah.
It will be around 5,000 rupees a square foot, 1,500 crores.
So, okay, but your attributable cash flow is only 5,000 crore, and you will have to spend 1,500 crores in this. That's what you're saying.
I'm just getting to the slide.
Yeah.
Yes. Yeah. Mumbai, overall 3 million square foot.
Correct.
The total number is at 65,000 if you take.
Right.
The total cash flows have been shown.
roughly 20,000 crore. On 20,000 crore, you have 26% stake, which is 5,000 crores.
Yes.
But you will have to spend on full.
So our spend is also proportionate, right? So 3.05 multiplied by 5,000 into 26%. So we spend around 400 crores. Our share of spend.
Okay. Only so on 400 crore investment, you get basically 5,000 crores. Is that how one should read it?
Proportionate, yes. Some amount of land costs have been incurred, and the balance, whatever need to be incurred, will be incurred. That will also be proportionate again.
And how much is that likely to be? Just to understand the potential of the project profitability.
We need to spend another 150 to 200 crores.
How much have you already paid for it?
It's lower 150 crores.
Oh, okay. Seems to be a super deal. Okay. Great. Thank you so much. All the best.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all the participants in the conference, please limit your questions to one per participant. Next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi, good evening. Venkat, you said earlier that our spend on JDAs would be about 4,000, 5,000 crores annually. And if you look at our cash flows or rather like operating cash flow run rate, which is again in the 4,000 to 5,000 crore run rate annually. And then, we have capex of 15,000 crores, which we'll spend over the next, 5 years or so, 4 to 5 years. Realistically, where do you think the debt will peak out here, at what levels in absolute terms? Because again, these cash flow numbers look quite aggressive.
Kunal, see right now 1,000 crores of free cash flow that you see is at a current run rate that we are operating. The business development outlay that we indicated is for the pre-sales of around 20,000 crores run rate. It's much more than the current operating levels. That also is a mix of some JDs and also outright buys all put together. The outlay that we need to have. Now, if that be the number, there is enough amount of residential cash flows that we can generate to reinvest. When the project is this quarter, we have got 1,000 crores of positive cash flows. But the quarter in which we have completions, a lot of money comes at the time of handing over. That quarter, positive cash flows will be a lot higher. So it also depends upon what is getting launched and, so majority of the cash flows in this quarter are from the sale of Lavender Field, where booking amount only has come. After that, installment money will keep coming. So we are confident that we will be able to generate around 2,000 crores of, or little around 2,000 to 2,500 crores of positive cash flows from developmental business a quarter.
This is going by the numbers that you are putting out, right? Say 30-35% operating cash flow margin on the collections. Right? I mean, even if you assume say 20,000 crores of pre-sales, and assuming that collections also reach 20,000 crores, which generally is about 80% odd, we would still be in that 6,000 crores, 5,000, 6,000 crores of operating cash flow range. And then again, still the spend on 5,000 crores spend on land, and then 5,000 crore on capex maybe. It just still looks a little bit of stretch, and this factor does factor in your residential cash flows, right? So.
Yes, sir. Still we stabilize at those numbers. See, if you look at some of these projects, I'm looking at the current market values. Project where we are deployed outflow last year, we are selling at 20% less than what we sold this year. No, don't look at only cash flows. Look at the margins that we generate also. So that's why I said cash flows could be lumpy. We hold 15-20% of the project till the completion, and when we sell that in that quarter with no additional outflows because construction must have been over, project must have been completed. If you look at our completed inventory from last quarter to this quarter, it's down by 1 million.
Sure.
So like that, because we didn't have much of completion this quarter, if you see. and the quarter will have high completions and where complete inventory gets sold, there is no construction obligations against the completed inventory. So all of it will be free cash flows. So you look at overall, don't look at a particular quarter.
Sure. My second question is on when we highlighted our this whole growth plan on the annuity business and the kind of capex that we were planning, we did put it out as a strategy that we'll do part strata to manage the debt levels. Has anything changed over there? Because now actually we are doing reverse of that. Like we are actually buying out stake instead of doing strata. So just any change in the strategy, or we'll still considering doing strata in future in these assets?
Definitely don't want to do strata. If at all we do something, we may induct somebody as an equity partner at some point of time or the other.
Sure.
Sorry, just answer your earlier question a little more in detail. If you see a residential, ongoing and upcoming, we have given you free cash flow that we can generate.
Mm-hmm.
Okay, so 29,900 crores across ongoing and upcoming, which is huge in number. So that will be over a period of next 4 years. That means around 7,500 crores of free cash flows a year. Even if you have to deploy around 4,500 to 5,000, this still will be left with 2,500 crores of positive cash flows.
So these are still pre-tax, right? And pre-tax and pre-overheads, right? These cash flows.
Overheads we have considered overheads and taxes. So if you see the slide number 29,
correct.
We have included all the payments, sales, marketing, overheads, taxes. This is after the free cash flows of 1,000 crores, is after admin overheads and taxes. No, even the other.
No, I'm talking about the free cash flow. That
even those also. We have factored in. Unless the rates change, current numbers have been factored in.
Okay, fair enough. And my last question was on you said earlier about bringing in equity partners. Just on that front, right? When we divested our stake to Blackstone, we were nearing debt levels of about 9,500 crores. We are currently at about 7,500 crores, right? At what stage would you look at doing that at the asset level, or even say doing equity dilution at the entity level, if at all?
Kunal, one thing, when we are comparing, we should also compare the current operating scale of operations and the current market. So, when we had 8,500 crores of debt from Blackstone, our pre-sale numbers, the peak that we have reached was 5,000 crores.
Mm-hmm.
Our business was operating at 5,000 crores. Now we are operating our business at 13,000 crores. And maybe hopefully if all goes well as planned, this year would be at around 16,000 to 18,000 crores. So in that light, you should see these numbers. Accounting numbers are completely different because they come for revenue recognition as and when the projects get completed. But the scale of operations right now is that number.
Sure. Thanks so much and all the best.
Thanks, Kunal. Thank you.
Thank you. Next question is from the line of Saurabh from JP Morgan. Please go ahead.
Hi. So just two questions. So one is, Venkat, around this commercial project in Bombay, in Worli. So what gives you confidence, that this takes off? Because that area has a lot of oversupply. And, your ex-JV partner is actually struggling there. So, so when you did your market research around this Liberty Towers, what gave you this confidence that this can be because this is the first project which will, the first large one which will come up in Bombay. So if you can just talk about that and any risk guardrails you've put in there. The second is, just on this cash flow slide, what is this 109 crores in the finance cost? Is this the other income or is there something else? Thank you.
No, it definitely will. The type of product that we are doing, I thought Venkat will answer that and he's looking at me to answer it. we are completely confident that it will meet a huge response, not a small response, so nothing to worry on that.
The kind of development that we are doing, given the specifications and the futuristic building, we are very confident that this will be much sought after building, and we don't have any second thoughts in that. We've done our own analysis before embarking on this. In fact, there's a lot of contemplation that happened. There are a lot of suggestions that came saying that we should make it as a residential project. It was
in fact, there's a lot more residential, so I didn't want to go through that route at all.
So that's what I want to get to, as to, what kind of research did you do to kind of come up with the conclusion that there is demand for 4 million square feet office space?
Not 4 million, it's 2 million in Mahalakshmi.
My apologies.
I really believe that not
micro market has this vacancy.
And for a brand new building with the brand new infrastructure and the type of product that we are making, there will be quite a lot of demand for it, because not only the existing new demand, but there will be a lot of relocations that will happen, because everybody would like to have a new office for themselves, and it'll definitely do well. We've done our work, and I don't think we have any doubts on it.
And sir, to answer the other question that Hamdan informed, that is partners infusement from minority interest partners infusement.
So the partner has put, that's cash take out from the partner.
Yes.
Okay. And just one last question, sir. So on this AeroCity, what is the debt in that SPV?
In AeroCity, the debt is 1,250 currently.
Total debt in that SPV, right?
250 crores, yes.
Okay. Thank you.
Thank you. Next question is from the line of Atul Tiwari from Citigroup. Please go ahead.
Yes, sir. Sir, thanks a lot for the opportunity. Just one question. Obviously, Prestige has been, launching and selling and delivering, a lot of projects, over the past 10 years. We have always seen it has been the best in the sector. But obviously, in the last cycle, even though we were selling a lot, the debt built up, and then, we had to sell our rental projects. So, what we are doing differently in this cycle, because very frankly, one recipe for disaster in the sector has been ramping up the residential business with the help of the debt, that we have seen, across the, companies over the past 15 years. So, if you could share your thoughts on that point and what we are doing differently this time to make sure that, the debt is sustainable and there are no cash flow issues later.
There are two things. One of the reasons why debt is has gone up compared to where we were is also the pace of growth. Instead of raising additional capital by way of any dilutions, etc., we are meeting this growth either through internal accruals or debt. You wouldn't have seen in the past, year on year, if you look at 3 years ago at 5,000 crores to now around 16,000 crores is 3 times the growth, 300% growth. And we need to gear up for it. That's one. And the second is, please look at the residential free cash. There were concerns earlier also. We are looking at creating these assets which are much more valuable than, can give much more returns than our borrowing cost and what the amount of money that we are borrowing. So at any given point in time, while answering to earlier question, I said the options exist for us to bring in a partner and reduce the debt, or complete this asset and bring in or sell it to somebody at a higher value, or create this and go to the public market and unlock your capital. So these options exist. We are not taking this money and investing in some lands which are futuristic, which can be monetized 10 years, 20 years, 30 years from now. That's not what we're doing. The proof of pudding is with every year, every quarter, we've been showing the growth in terms of operations. And every bit of this money is going to to take the organization to the next level of growth. So the asset that we are creating, the free cash flow that we are going to generate out of residential will definitely take care, and they are 3-4 times more worth than the debt that we carry in the books.
Okay, sir. Okay, thanks.
The overall debt that is available that is there in the balance sheet right now is equivalent to our free cash flow from the ongoing projects. So all of it, if we are to use it to repay the debt, it will be zero. But we also need to look at the growth.
Okay, yeah.
Thank you.
Thank you. Ladies and gentlemen, we will take this as the last question for the day. I would now like to hand the conference over to the management for the closing comments.
Thanks, everybody. It's been quite an insightful and interaction. We definitely have heard you, and we've also understood the concerns. But nevertheless, we are quite confident in what we are doing, and we are sure we're going to bring more and more value as we go on to the company. And believe you me, residential is doing well. It will continue to do well. There's no question of any doubts in our minds on that. There is enough demand in the market, and there is a lot of consolidation also, which is helping our cause. And by sheer delivery, there is a confidence, and that's why customers are coming to us as compared to any other developers. So that helps our cause.
Thank you very much. On behalf of Axis Capital Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.
Thank you.